Hello and welcome to Crux Investor. We caught up earlier this morning with Mitford Mundell, new CEO for Africa for Theta Gold Mines. He talks to us about his change of strategy for the company from open cast to underground mining for high grade gold. They've got a 15 million bucks at the market facility in place. We're kind of interested to see how he sees the next 12 months. And if you want our thoughts and opinions on what he said, the company itself, their plans, generally, and Mitford, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. We've got commentary from experts from around the world on a variety of companies and commodities. We've got training courses on there. We've also got summaries of all the interviews that we've done just to save you some time, because we know you're busy people. But most of all, there's a wonderful, thriving community of investors sharing their thoughts and ideas with each other in a nice, friendly, safe environment, free from all that judgment, trolling, and abuse you see elsewhere. And if that sounds nice to you, and I hope it does, go and join them at cruxinvestor.com/club. There's a bit of a wait list at the moment, but it's well worth the wait. So do sign up, cruxinvestor.com/club. And we'd love your thoughts and opinions too. So give us a like, leave your comments below. And if you want to see precisely what we talked about today with Mitford, take a look in the description below. Mitford, how are you, sir?
Very well. Thank you. Yourself, Mitt.
Not too bad, not too bad. Glad to be speaking to you. You're the new CEO, so as far as we're concerned, we haven't spoken before, at Theta Gold Mines. So where in the world are you?
I'm in Johannesburg, so based in South Africa. That's where our operations are at the moment. So I live in Stellenbosch in
very
Western Cape. But I spend most of my time away from home now.
Yes. We're about to hear all about it. And how are things down in South Africa? I haven't had an update for a while.
Yeah, so things are sort of picking up. We passed the big lockdowns, hopefully for good. Inoculations started at least, so hopefully that will also pick up. But the economy is slowly starting to pick up, and in terms of the mining industry, it goes full speed. Hopefully we can start to get the overseas tourists back soon.
Well, I certainly agree with the last bit. I'd love to get back there. I'm glad all is well, and it's business as usual in the mining context. Hey, I tell you what, before we meet you properly, why don't you give us a 1-minute overview for people new to this story, and I'll pick it up from there with some questions.
Okay, so Theta Gold Mines, it's an ASX listed company, and we've got about 6 million ounces in gold resources in South Africa, about 350 kilometers east of Johannesburg. Basically, we control our own Goldfield there. It was the basis of the first gold rush in South Africa, and when, in those days when everyone scrambled sort of to the Witwatersrand, when that was discovered, it was a bit neglected. And that's good for us because now we still have it. So 6 million ounces is really just the start of where we are. We've got about 40 old mines that we haven't even started looking at. So it's not sitting in the resource. So a lot of work, happening to bring that into the resource as well. So there's a plant and tailings facility that we need to upgrade as we now in this development phase of bringing these mines into production.
Brilliant. Okay, well, we're going to talk about that in a second, but I guess we better get an introduction to you. We've heard your name mentioned when we've interviewed Bill. I spoke to Bill off camera, I think October, November as well. So you've come in as the new CEO Africa. Well, there is only one asset, and it's in Africa. So you are the CEO de facto. So when did you actually join the company? Because I think you were involved prior to being appointed CEO, weren't you?
Yeah, I was approached for the position sort of beginning of last year. We started the conversations. I looked into it, and it was I was doing my own thing as a business coach after I left my previous position as CEO of Mitford Diamonds. And we decided I'll first give it a good look. So I started about this time last year, just getting involved as business coach for the team at the time. And immediately we just started sort of investigating. I brought our current CEO, Chief Operating Officer, that started in the end with me. So he also came in. We did our sort of investigations and got to the point probably around August last year to say, okay, yes, we'll take this thing on. It looks good. So I started officially in the position in October and jobbed the tree with the CEO as well.
Okay, so a couple of things there. So what is a business coach?
Well, it's somebody that asks a lot of questions to people so that they come up with the best answers for themselves. But you just need to know what questions to ask, I guess.
Right. But I just want to be clear about the separation between, personal coaching for business executives and business coaches, which are looking at companies. So you're the latter.
Yes. No. So it's the process. The coaching process is the same thing. It's the same process, but focus on business. So you're not going to sort of help people sort out their marriage problems when you're a business coach. You help them sort out their business issues. Yeah.
Right. Okay. So I would probably use management consultancy. So you're coming in, looking at a business, going, what's right, what's wrong, asking all the dumb questions and all the smart questions, and seeing what is uncovered. Okay, understood. Give me a little bit more about your background. You mentioned a company that you were CEO of, and I also know that you were at Harmony as well. So give us a little bit of background, if you don't mind.
Yeah. So I started my career in 1988 as a learner official of the bursary with Rand Mines at the time. Studied mining and so over time, spent 12 years working for Harmony, going through all the ranks. I was a miner and a shift boss and a mine captain and a mining manager and a general manager and a business coach. Actually, we actually had a position business coach at that stage, which was basically like a sort of divisional chief operating officer. And then the last few years in Harmony, I actually ran the company's business improvement section. When Bernard Swanepoel left, I thought, well, it's a good idea for me to also make a change. And I ended up working for De Beers for 5 years, chief operating officer of the Namibian operations, and then pulled into the head office again, also to run the company's business improvement. So for some reason, every time I get pulled into running business improvement. And then I was approached by Namakwa Diamonds, and I was CEO there for 5 years, operations in Lesotho and South Africa. And that was also sort of an optimization project, really, if I can call it that. And we took that mine life from originally 3 years when we arrived there to 20 years now, and my team's still going strong there.
Right, fantastic. Okay, so just again for the viewers here, just trying to understand some of the vocabulary and terminology here. So, looking at a company's operations or optimizing its operations is one component. Managing the market is another. So, were you focused on one or both of those things in your previous roles?
Yeah, so Namakwa, managing the sort of full spectrum, and obviously in diamonds, it goes right through the cycle to the sales cycle, etc. But it was a private company, so we had one investor, so didn't have to raise money, in other places. And now in this position, really my primary task is to get these operations running in an optimal way. That's my basic skill set, but obviously I work closely with Bill and Richie on the investor side as well, and telling our story. Yeah, that's really what it is.
Yeah, talking about Bill Guy and Richie Yang there. So you're working with them. So your focus is really optimization of the project here. Now, what you have done, you've walked in and changed things up a bit. We're now going underground. Change the strategy, right? So how did you get to that point? Was that what you were brought in to do? But what did Bill say? Here's what I need you to do, please, Mitford.
Well, the starting point was, well, come and build this mine, which at that stage was the first stage was an open cast operation, and then flowing into the underground. And so during my time before I started in October, Jacques and I, looked at sort of looked at it as a clean slate, not just what was given to us. And the thing is about these ore bodies, there's multiple adits that basically run into the mountains. It's flat lying, very shallow reefs, and you can basically just walk into into all these mines. So underground is not the sort of, in a traditional sense, it's a big project, you have to go and sink a shaft and then you get underground. So it's really comparable to the sort of ease of entry of the open cast. So we took a good look at it, and the sort of speed of getting into it is the same, but the grades are better. So we quickly got to the point where we realized this is where we need to go. And that's the strategy that we put on the table and that we're following now. So we have the open cast, but the open cast also, it's, apart from the fact that it's low grade, and it does have a very good, it's got very good financials, and we've done a full feasibility study on it. But the underground is just better. And it's not the one or the other, it's going to be integrated over time. But the starting point, getting to first gold, is going to be underground.
Right. Okay. You've done a PFS. So I'm sort of diving straight into it. And for existing shareholders, I guess that's what they'll want. For people coming at it new, perhaps worth watching the previous interviews with Bill on how we've got to this point. So the PFS and indeed the metallurgical work have told you what? I mean, what were you looking? What were the questions you were looking to answer? And of course, what's that told you or allowed you to make the decision? Underground is better. The economics are better. So if you give us some of those numbers and the thought process.
Yeah. So as we sort of stand, I mean, the open cast project gave about $800 an ounce, between $800 to $900 an ounce, all in sustaining cost. So we needed to get to something similar, and so we had to very early on determine what the sort of cost would be for this underground, and it turns out, and this pre-feasibility study that we've now done on the first 3 mines, it comes over the life of almost 8 years to an all-in sustaining cost of just over $900 an ounce. Now, but that is not the whole story, because our pre-feasibility study, we've excluded all inferred resources. So it's got a drop off in the last few years, and that obviously has an effect on the average cost. But at peak production, it comes in at $800 an ounce. So it's very much in terms of cost comparable. But with the first plant that we put up, you're just going to get many more ounces with a higher grade at the same cost per ounce. So it just very quickly made sense to us. And the cost that we have in is, we've got a contingency of 15% on the working costs and 20% on the capital cost. So we're very positive about the cost numbers. And as we now conclude our bankable feasibility study, those numbers will come down, because we'll actually add another mine into it, a fourth mine into it, Rietfontein, that's a higher grade, also easy access. So we see all-in costs of under $800. And this pre-feasibility study only looked at about 16% of the underground resource that we have. So it's really just a starting point for us. And there's, over the next 5 years, we plan to bring in 6 of these mines, which we've identified, the first 3, and then very, very quickly after that, the fourth one, Rietfontein. And then the biggest mine, actually, Linsleidenberg, that's produced most of the biggest production in the old days. That's actually the 6th one that we'll bring in. So it's like, somebody said the other day, this is like a dog catching a food truck. You don't really know where to start, but now we know. We know for a fact, and now we're full speed.
Right.
Focused.
So nice analogy. because it answers, well, I think it begins to answer a question which is most people will be nervous about, which is you're talking about a maiden resource of 419,000 ounces. It's not a lot. But if there's a plan to go and add to that quickly through looking at an additional 6 or 7 mines, then I guess that can happen. But that's going to cost you money. And
well, sorry to interrupt you, Matt. It's actually not just looking at the regional or the other mines. And it actually is not going to cost us that much money because the ease of entry into these mines is, they're all very, very easy. The only reason is we've got 150 years of data. So that's the starting point. We don't have to go and put a hole in the ground in most of the cases because we actually have the sampling information of the last faces that's been operated. And we can actually access many of those faces. This over 400 ounce reserve that we've just declared now, that's not looking. If you look at the mine plans, you'll see how sort of artificial that number is actually, because the inferred resources just expands from where this mine plan is. So immediately when we start in these mines, the development into the inferred areas and drilling work there would also start. So it will be a natural, almost part of production process to increase the reserve of the working mines while we're bringing in all the other mines.
When we spoke to Bill back at the end of August, beginning of September, 26 cents, 24 cents today, but there wasn't a sort of immediate reaction, I think, after you came in. The price went up to, I think, as high as probably 40 cents, right? And it's come away again. Do you think it's a case of people are excited about having you running this thing, a local guy running the operations? Or do you think there's something like, the ATM facility which is going to put them off? Because you've come right back down to 24 cents again. So people got excited and then they're not so excited. So what happened there?
Look, I mean, obviously with the change of direction, people would be concerned, right? Rightly so. Me coming in, I'm not necessarily, that well known maybe outside. I'd like to sort of stay under the radar, and having worked for, a private company over the last 5.5 years was, didn't really go and talk to the world about what we were doing. And the ATM facility, that probably is something that the market looked at and said, well, what is this? But to me, the fundamentals of the business is what's important there. I don't think there are many resources like this left where you have a starting position of 6 million ounces, extremely flexible in terms of access, and this is going to expand. So the 6 million is just a start. So I think when people want to see us now develop, I think that's what, enough talk. I think the investor world now wants us to see develop this thing. So we need about $50 million over the next year or so to complete our feasibility work, and to do some more exploration work, etc. But core to starting up is the feasibility work that needs to be completed, and we're beyond the pre-feasibility stage actually. So we're already well on our way to taking it to a bankable level. And so that's what people want to see. They now want to see progress, and that's what we get for. And the capital, we plan the first phase will give us, it will sort of peak at 70,000 ounces per annum. And that, as I said to you, is really just a starting point. So the build-up to 160,000 ounces per annum within the next 5 years, and I think Paul also spoke about that. That still stands. It's still the same. In fact, we have to sort of throttle ourselves a bit, to stay on 160. But I mean, that's what we put out there, and that's what we plan to achieve. So people want to see first gold, and that's what we're on the way to.
Okay, so there's a few things there, Mitford. I just want to be really, really clear about how this thing gets pieced together. Okay, you talked about another $50 million or so over the next year, right, to get a feasibility done. You said to me earlier, it's quite cheap. It's not expensive. Not cheap. Yeah. It's not so expensive to add the ounces, because at 419 60,000 maiden resource, no one's really interested, I suspect. But how quickly will you be adding those ounces? What is the actual cost of that in relation to the 50 million you're going to raise?
Yeah, so 1.5. So we need
1.5. Thank you.
1.5.
Thank you. 1.5. 15.
Yes,
which is this at the market facility that you've put in place, is it?
Yeah, so it's that plus, there's various conversations happening, to raise that. So that obviously would be more of an equity raise. But then we'll be in a position where we can give, a very sort of confident sort of plan, and then we need about $40 million to build the first, basically bring the first mine and the plant and the tailings facility to production. So all in all, we need about $55 million to get into production, and then after that, the short payback we don't foresee unless we want to do it for gearing ratio purposes or something. We don't actually foresee ourselves needing to go back to the market after that. The build-up will then be able to be self-funded.
Right. Okay. And so the numbers that Bill's talked about previously, 160,000, I remember, but these are going to be ounces from different places because we're going underground now. So it's different from the open cast, open pit solutions. So again, people are going to be interested to see how you're going to do that, given it's sort of early stage in the underground thesis for you. So how do you deliver 70,000 ounces, and when does that manifest itself?
Yeah, so we the mining method that we'll employ is a mechanized longhole stoping, and that's one of the sort of game changers really compared to conventional mining. So basically, for the 70,000 ounces, we need to put in place 3 what we call production units. There's a set of equipment that will deliver between 20 and 30,000 ounces per annum in terms of capacity with the grades that we're working with. So just to give you an idea, Beta mine, which is the first mine that will start up, that alone can actually accommodate 3 of these production units. And so we're going to start up 3 mines because we want to and it sounds like a lot, but because these are really just the adits running into the mountain, we're actually creating flexibility from the start. So between these mines that we'll start off, we'll have capacity to start 6 production units. But this is where we start, and then we adding the other mines as well. We'll put ourselves in a position to go beyond this 160,000 sort of ounce that we put in there by doing that. So we don't want to sort of go put all our eggs in one basket. And the timelines to get into these mines are very short. I mean, we walk into these mines today. It's amazing ground conditions. So it's really just equipping, putting services, getting the mining kit, and start mining. So really, what we need to upgrade the plant. So we've done metallurgical test work on 4 mines now. Initial test work, very encouraging results, and then we've done in-depth test work on what to start with the most difficult metallurgy of Frankfurt mine, and very encouraging results. So we know what our metallurgical solutions will be, sort of almost worst case. And we've got so in the pre-feasibility study we've got an 84% recovery factor. But I'm very positive that number will go up.
So I guess if we piece some of the information together, so you're saying the metallurgical, you've gone for the most difficult. People need to understand the importance of the metallurgical. So recovery, 84%, good. Economics, you suggested earlier, will be good as well. So the network's giving you comfort on not just the recovery, but the economics too.
Yeah. Right. So on this initial pre-feasibility study, which, as I mentioned, is really just a starting point. There's an NPV of about $91 million on that project. The payback from start of production is about 13 months on that project, and that's on a gold price of $1,570 an ounce. If you look at around at the $1,700. Hopefully the gold price stays there, then NPV of $150 million. it's the cost, without making predictions about the gold price, but the low cost that we're able to operate in basically makes us robust against any gold price. So the IRR, 83%, so it's a good solid project as a standalone, and it's actually it's not an optimized plan, because we're not filling the plant. We have surface sources, as you can imagine, lots of dumps from the old times that we have access to. So we basically from day one would fill the plant as we build up a profile, and the drop off at any stage will fill also with surface sources.
Right. So you're blending tailings in there as well. Why most people would be keen to optimize the plant and have it running at full tilt. Why are you suggesting otherwise?
No. We will for sure. But as a starting point, we just looked at the 3 mines underground resources as standalone project, and we, as I said, we excluded inferred resources. So it's not optimized from that sense. It gives an initial indication of the economics by basically sweating the assets, which we will obviously do by filling the plant with various sources. We just the economics will be better than what we can do.
Right. What's the size and what's the grade of the tailings component? Because obviously there's a lot of mines around there, or former producing mines. There's got to be a lot of tailings. Have you put a value on what could be contained in there, metal in the ground?
Yeah, so we have lots of. It's not just tailings. We have old drop dumps actually. In the old days they hand sorted, so they would bring the ore out from underground, and they would actually have people hand sorting it. And so we have dumps that comes from the 1920s and 1910s that's lying around of actually rock dumps that you've got grades up to 2 grams a ton lying in that, and then we have tailings as well. I mean, we're busy looking at whether we're going to bring in tailings early on, whether we're just going to focus on the rock dump. So that's all part of the sort of studies that we're busy with. But there's about 1 million ounces lying in surface sources, right? Not open cast, surface sources, dumps lying there.
Right. Okay. So let's look at how this thing gets pieced together then. So you're suggesting 70,000 ounces is a reasonable target, ramping up to 160 in 5 years. So is that right?
In 5 years.
Right.
Yes.
Okay. So you also mentioned exploration. So exploration to what end are you? I know you've got 150 years worth of data. You've got to process that. I can't imagine it's all digitized, but what does that process look like going forward to you? What is the focus? How much effort are you putting into that in terms of dollars?
Yeah, so as you say, I mean, most of it's not digitized yet. I mean, so what we have in the 6 million ounces has been, that's been the focus of the studies until now, with some exploration drilling that Bill would have spoken about in the past, mainly for the open cast. Now, with these adits that run into the mountain. So most of our exploration work would be done from underground. So between you start up a mine, you start mining there around the areas where you have the confidence, and then you explore from there. So that's going to be most of it, between advanced development and exploration drilling from underground. But there are areas as well where we will do some surface drilling. But that's not the main focus at this stage. We've got enough to keep ourselves busy for quite a while.
And how much money are you allocating to that?
So there's a bit within the $15 million that I spoke about. There's a bit allocated to that, but it's not much drilling. It's more the actual investigation and working with our partners, Minexcom, to actually bring these other old mines into play as well.
Well, that answers the question. I'm trying to work out where you attribute your efforts, because you've got I think at a 120 million market cap, you're going to probably tell me you're undervalued. Well, you should do if you're a public market CEO. What sort of information do you need to put into market? People like to go with high grade headlines. Other people like to go with, I've got 6 million ounces What's the story that you want to come to market with?
Well, I would just tell the market, 6 million ounces is significant to start with, and that's only looking at 6 mines really, and there's another 40 that we have 150 years worth of paperwork and access. Just last week, Jock, the COO, phoned me with excitement, having walked into 2 of the other mines, so I said, wait, we've got our hands full for now. But so this is really just the tip of the iceberg that we have here, and looking at the economics of this first phase, and knowing what that's almost 8 years of production on its own, and it's this thing is big. And I mean, you talk about underground mines, starting underground mines. Starting one mine today would be more expensive than what it would take us to start 6 mines. So I think people will slowly start to realize what this thing is when we start to get into production. Because we may be talking too much about it. Maybe we should just do.
Never minded that attitude. But here's the kind of dilemma I think investors have, which is like, you've got 6 million ounces you've announced, but that's from open cast, right? You've got let's say 420,000 ounces from the underground, and is there much overlap there, or are you going to have to announce to market a whole set of like new resource numbers in relation to the underground, and also therefore what's actually left in all of these mines, because they have been mined?
No. So the 6 million ounces underground open cast combined, that's what we have. The overall reserve now, the underground plus the open cast, is under 580,000 ounces. So that's where we stand now. The open cast will be brought into the plan, as we expand the plant capacity. So we're not walking away from the open cast.
No, I understand that, but what was the timeline before you were able to kind of monetize that? Some of it.
Yeah, look, I mean, as we now stand, I mean, if we're going to fill the plant with 5 grams a ton plus from underground, and we have enough to fill it, building up to 80,000 tons per month, which would take us to our 160,000 ounces. We actually don't have a place in there for the 2 to 3 grams a ton from open cast. So, but that doesn't say that that we can't expand the plant capacity further. So at this stage, within the next decade, the focus would be, if we limit ourselves to 80,000 tons, it will be mostly on the underground.
Right. So it begs the question then, you've got 6 million ounces with open cast, right? That's great, but all the value's in the ground. So how do you benefit from it? How do shareholders benefit from it? And do you have to spend any money you make from the underground stuff to actually access the open cast? Do how's that money flow look to you?
Yeah, no, the open cast is the underground. Out of the 6.5 million ounces, or 6 million ounces, 4.5 million ounces. That's underground. So the open cast is actually it doesn't have as many ounces, and so that lies over 2 mining rights. There's other opportunities as well, but the first one on mining right 83, which was the focus. So that one, the work's been done. We can bring it in at any time. As I say, investors will, I don't think they really care where we mine from, as long as we give them the best return, and that's what we're going to give them. Better than what they would have received if we just stuck with open cast plan.
Yeah, no, I understand that, and yeah, you've got to create value for sure. But the question is, so a lot of what we have seen in the past with companies is they kind of don't create value, because any money that they do create, they pump back into the ground, and the shareholders don't get the benefit of it, because it's just continuing mine, pump the money back in the ground attitude. I'm just wondering your attitude, yes, which is, how you're coming at. I think you've been quite clear, but it's probably worth stating again.
Yeah. Look, to me, I don't like asking for money. So to me, that's I want to get out of that position. I want to give money. So, so that's what we're going to do. Being self-funded after the first phase, and I think getting into production and then building. We're talking about 3 decades. The first decade, building up to 160,000 ounces would only consume about 1 million ounces, and that's just with the current resource. So this thing, it will become self-funded, and the constraints, would quickly sort of diminish. It will really be our own sort of capacity that we create around ourselves that would determine how big we go here. At this stage, we focus on the 160,000 ounces, and that we will deliver.
Beautiful. Well, thank you very much. One, nice to meet you, and two, thank you for explaining the new strategy and how you're going to deliver it. I think in terms of just today as an introduction to you, that's been really, really useful. And perhaps if you come back on, and I hope you do, we can sort of dig into the weeds a little bit about how you're going to deliver the project scaling over the next few years for sure. And you can explain to me why your company is investing in digital-backed bullion asset management at that time too, right? Okay, well, look, Mitford, thanks so much for today. We'll speak to you soon. Stay in touch, okay?
Thank you, man. Thank you. Thanks for having me.